So as Iklak was saying, my background, I spent almost 20 years working in startups. Had a number of those startups go public, but actually started life as an entrepreneur. Did that for a really long time. Did every role from grunt engineer to CEO, and then I've been VC for the past 13 years. So I've seen kind of both sides of the equation. And the purpose today of me talking to you is to kind of give you the gestalt of what it's like to be a venture capitalist, because that should inform you as you're thinking about getting companies funded, and also give you the gestalt of what it's like to be in the trenches in a startup. So I'm a pretty informal guy, so if you have any questions, if anything I say doesn't make sense, stop me. I have 45 highly technical slides with all kinds of formulas. I'm going to go really quickly through them because they're so highly technical. So stop me if you have any questions. Before we get started, how many people here want to be entrepreneurs? Good. Very good. Anyway, yeah. How many people want to be work in venture capital? Okay, good. It's better being an entrepreneur, by the way. Yeah, yeah, truly. So we'll get started, and let's see. So everyone says here, pretty much everyone wants to be an entrepreneur, and this is why, because the outside view, and there's even an HBO show about Silicon Valley startups. Outside view of being in a startup is like this. You get picked up by your Rolls Royce. Spend your time sipping some fine wine, spend time in your yacht, your chalet in France, and then you play golf. And this is why you want to be an entrepreneur, because everybody sees the Facebook, Google, all those successful guys, and that's what they think startup life is about. As I mentioned, this is really a highly technical discussion here, so I hope you're getting all of this. But the reality is, this is what startup life is like. So all those years I spent as a startup entrepreneur, like every night I'd wake up in a cold sweat saying, what am I going to do? Because life is really tough, and it's just you battling against the world. And in particular, startup life as a startup company itself is you're faced with all these big competitors. So nowadays you've got Google, you've got IBM, Microsoft, Oracle, and all these guys are huge. They've got 40,000, 50,000, 100,000 employees. I think in IBM's case they have 400,000 employees. Oops, excuse me. And then there's your startup. Okay. Questions about any of this? Is everybody getting this? Yeah. But this is true, So you're this tiny little company. You're doing battle with all these bigger companies, and it's really daunting and scary. Iklak mentioned I've been at Broadvision. At Broadvision, we won a deal for $4.5 million in 1995. It's the deal that made the company. It's enabled us to go public with Virgin. Okay. We won that deal when we had 17 people in the company. We beat Microsoft, IBM, Oracle to get that deal. And that was in the UK, of course. I think we had 17 people in the company. Oracle probably had more than 17 people answering the phone at the front desk in Oracle UK. Okay, so this is startup life reality. So why do you want to do a startup, right? So here's why you want to do a startup. This is scientifically proven, NSF-funded study, but best job in the world, NFL quarterback. Okay? Second best job in the world, startup entrepreneur. So I did startup entrepreneuring for a really long time. I've done venture capital stuff for a really long time. It's better to do that thing on the left. The reason why I work at ONSET, why do I do venture capital, is because we do early stage venture. I spend all my time working with the entrepreneurs. I don't sit in my office doing spreadsheets and term sheets. I actually sit down and work with the entrepreneurs, and that's why I like working where I do. But it's a really good thing to do. It's really tough to do, but it's a lot of fun. And by the way, for all you Cal fans out there, this is that should be Kyle Bowler playing quarterback for the Raiders. Not very well, though. So you want to start a company. The two questions I get asked is, how do I get started? And how do I get my startup funded? And that's what we're going to talk about today. Okay, so here's the entire secret. If you remember nothing else, this is the one thing you want to remember. The secret to Silicon Valley success is, any guesses? All right, no guesses. So they failed the pop quiz. Know your customer. So who are your customers? One person tell me. Who are your customers? Somebody catch my eye and I'll point you. How about you? Who are your customers? Yeah, in the white. Yeah, yeah.
So like a startup we are talking about?
Yeah, what's your definition of your customer?
Like the
Okay, and they're going to pay you somehow, right? You're going to get money out of it somehow. Yeah. Right. So I'll keep doing this. The definition of who your customers are is people who give you money in return for something, right? And that's the number one thing to understand. When you come talk to a venture capitalist, ask you, so how are you going to earn money? What's your business model? How are you going to earn money? Who's going to give you money, and why are they going to give you money? So you have to know those people. So there are what I call the real customers, the people who give you money for your products. Is there somebody else who gives you money for something when you've got a company going? You. Perfect. Exactly. Thank you. Yeah, investors. They're going to give you money for equity. So when I say know your customers, you have to know both of them. You have to know your end customers so that we're going to give you money. You have to know your investors so that you know what to tell us so that we give you the money. Okay, so that's what we're going to talk about today. So if you're successful at understanding both, you're going to have a successful startup because we're going to like that you know this. You're going to like that you know this so that you can get our money. So that's the topic of today's discussion. All pretty clear so far? Yeah. All right. So knowing your customers, VC investors, every startup needs investment capital. What is it that drives me as an investor? So how do I get measured of whether I've succeeded or failed? You as a startup CEO or founding team, you're successful if your company's revenues go up. What is it that I get measured on? Sorry? The co-founders? No, what's going to get me fired or lets me continue doing my job? Excuse me, sorry? Valuations? Yeah. And yeah, exactly. It's I'm in a business where I have to return money to my investors. That's how I get measured. And specifically, it's returns, right? So if I have returns to my LPs, they're going to give me more money, and I can stay in business. If I don't have returns to my LPs, I'm out of business, and I'm working at McDonald's. So LPs typically expect like a 3x return on a fund. So if our typical fund is about $200 million. We have to return $600 million to our LPs for them to think that we're doing a good job. And it's because venture fund is measured over the course of about 10 years. So over that 10 years, they expect to see a 3x return. If we don't give them a 3x return, we're out of business. And the math that informs this is that about 1/3 of all startups, 1/3 of all of you sitting out there are going to be grease spots on the wall. The company's going to go completely out of business. We will never make a cent out of it. Your company will be out of business. You'll be doing something else. We'll write off our entire investment in the company. About another 1/3 merely kind of exist. So they're in business. We funded them. They're getting revenue. The revenues might even be going up. They're roughly profitable or break even. But they're not growing, so they're not going to exit. They're not going to go out of business, but they're not going to get acquired because they're not going to add to anyone's bottom line. They're not going to go public. So we don't get liquidity on these guys either. The company might exist. You might see it in our portfolio, but we're going to get no liquidity out of this. And so what that means that the 1/3 who actually survive and exit need to return 9x for us to be able to give this 3x back. Okay? This is a really important thing to understand because every company we see, we're looking for that 9x. So we're not thinking, oh, we might get 1x back on this guy and 15x on the other guy, and they're going to average out. Every company we see, we want them to return this 9x to us because we know that 1/3 will die and 1/3 will just kind of hang around. So when you walk in and talk to me, you want me to think that I'm going to get my 9x off your company. This also means that there has all sorts of other implications. It means that you also need to go after big markets because are you going to get a 9x return on a small market? You're not. So we really care about big markets, and you'll see quite a bit of that here in the discussion.
Sorry, 9x in 10 years?
No, we want to see a 9x. We get measured across 10 years. We want to see your company exiting in probably 5 to 7 years at 9x. That's our ideal. So every company that comes in, it has to hit that 9x bar. If it doesn't hit that 9x, you say, yeah, we're only going to get 2x. It's a good company. We might get 2 or 3x back based on multiples nowadays. We're not going to put the money in. We don't care about 2 to 3x.
From C funding to A round, 3x is acceptable, or you want a 9x from C?
No, the 9x is on your exit. So when you get public or get acquired, whatever. Okay. If we'd put in 20 million, we're expecting to get 180 million out. Okay, and you can do the math on this. If it's 180 million and at exit we have whatever 15% of your company, what does that imply in terms of your exit valuation? Okay, so this is the thing that governs my life. If I don't do this well, I'm out of the job. So just remember this. So this is the thing that, I might be sitting behind the table looking high and mighty, but I'm getting judged by somebody just like you're getting judged by somebody. So, this is outsider's view of life as a VC. So in reality, I'm sure there are some VCs who actually enjoy that life, not me. In reality, this is what life as a VC is like, which is it's you on this tightrope. Because you think about it, at our company, we've got 4 partners. All of our LPs know which companies I've invested in. They're kind of underneath my name. So if my companies are not doing well, are my LPs going to say, yeah, we're going to give you more money. That Shomit guy, he's screwing everything up, but we're going to give you more money. Is that going to happen? Not going to happen. So in VC, it's kind of unique in that if your companies aren't doing well, you're out of a job. If you're at a startup, for example, and the startup is underperforming, it could be any one of the founders who's screwing up. So you can say, hey, your company's underperforming. We don't know if it's the VP of engineering, the VP of sales, the VP of marketing, but you guys got to fix this. We're not going to say that you should fire all 3. So there's a lot of blame to spread. Blame can be spread around to many people, especially if you're working at a big company at Oracle or IBM or wherever, Microsoft. No one can say it's all ICLOC's fault that we missed the number, right? It was? Okay. Because you've got, at Microsoft, you've got 50,000 employees. If you miss the number, hey, it's probably collectively the fault of many people. In the venture capital business, everyone knows the companies. And my LPs, they all know which companies I've invested in. Once a year, we have our LPs come in. We tell them the results of all of our companies, how they're doing, where they are, how they're tracking. It's pretty easy for them to see if I'm doing a good job or not. Okay? So I actually live a pretty paranoid life. I don't get to live this life. I get to go through life like this. And if I really screw up, I end up like the guy in Jaws, which is there's my LPs and there's me, and me trying to fend them off. Okay? So this is, at the outset, I said I want to communicate to you the kind of gestalt of being a venture capitalist so that you understand what your customer on the other side of the table is kind of living through. And this is kind of my life. So I have a very paranoid existence. Every company I look at, I have to be paranoid and think about, am I going to screw up on that and end up like that guy there? Am I going to get my 9X, et cetera, et cetera? So just bear that in mind.
It's a great perspective because they think that you're the shark and that's them.
Exactly. And don't think that. There are VCs out there who are so hugely successful that they can be the shark down there, right? And they're out there. I'm not one of them. Most VCs you talk to don't have that benefit. Yeah.
How much percent of the LP's money goes to operation?
It's pretty small. We pretty much almost all of it goes to investing in the companies. And you look at us, we've got a very small operation. Our typical fund is about $200 million. We've got 4 general partners, 1 associate/VP who supports the general partners, finance staff, and some admins. That's it. So there's not a lot that goes into operations. Yeah.
Is that 3x goal, is that pretty standard for the industry?
Yeah, exactly. Because, as far as the LPs are concerned, we're an asset class. So if you're an endowment or a pension fund, whatever, and you've got, $10 billion, you're going to say, okay, we're going to put $1 billion into real estate, $1 billion into public equities, whatever else that they put it into. Let's say we'll put $1 billion into private equity. And so and part of that private equity, you've got hedge funds, and you've also got venture capital. So we're being measured against all those other possible asset classes. So, when an LP looks at us, they say, we can either give money to this venture capitalist at ONSET, or we can put it in the public market. We need to be able to say, hey, we're going to at least perform as well as the public market. Otherwise, they may as well put the money in the public market. So that's a pretty standard hurdle rate. Yeah.
So as entrepreneurs are looking for VCs, are VCs looking for LPs the same way?
Yes, exactly. So the same, you picture yourself going on bended knee to the VC saying, please give me money. Guess what? We're doing the same thing to LPs. So yeah, we're going and kissing the rings of LPs all the time because if we don't have the LP money, we're out of business. By the way, if any of you is fabulously wealthy and wants to put LP money into ONSET, see me after the talk.
And do you consider that largely Wall Street money? I mean, is that the capital
Yeah,
equipment?
it's basically any large financial institution. So it could be an insurance company, could be a pension fund, could be a university endowment. Anybody who's investing for a very long term. Okay, so anyway, so that's my life. Okay.
What's a typical success rate for you? I mean, do you hear 100 pitches and invest in one? Or?
That's a really good question. I actually have a slide coming up in a little bit later. But on an average year, and we're a mid-sized fund. We're not a behemoth like Sequoia, nor are we a small boutique fund. We're a mid-sized fund. We've got about $1 billion under management across all of our funds. We see 10 deals a day sent to us. And so this year we'll have seen 2,500 deals will have been sent to us. And we'll invest in for. Okay, and we'll talk about the physics of how you navigate through that. There's another reality here which afflicts and vexes me, which is the graph I'm about to show you here. So here here you see a good startup. Series A, they get money, the revenue goes up over time. That's a good startup. Every startup should be like this. Okay, this is what we hope all of our startups to be like. Here's another startup. It gets some money. Because you put money in, the revenues go up. Business really isn't there. Business flattens out, drops to zero. Company goes out of business. Can you tell the difference between these two companies over here? No, right? So this is why Series A is really tough, because everybody could be Bart Simpson for all you know. Everybody could be Albert Einstein. Really hard to differentiate. So, and this challenge is compounded because if you look at your next round, Series B, you still can't tell. Company got an investment, revenues went up, but which company is going to end up as Einstein? Which one's going to end up Bart Simpson? You still can't tell. So many venture funds will avoid the Series B. And so you might have heard of this. There's a Series A crunch. There's also a Series B crunch because people will say, we're going to wait. We're going to wait till Series C, because by the time Series C comes around, you know that this company's on a good trajectory. You can actually overpay. You can overvalue the company to get into the deal. So you get into the deal. It doesn't matter if you overpaid because it's on this trajectory, so tomorrow it's going to be worth more anyway. And a lot of venture funds do that. They play the momentum game. They won't do Series A or B. They'll wait till Series C. And there are venture funds which will, if they like your story, they might invest in your Series C, but they'll crush your valuation to take your company for $1, basically. And then they'll try and turn it around. And there's very little risk to them because they bought your company for $1. You've already built the technology, et cetera. But worst cases, nobody will come in and you'll end up shutting the company down. Okay? So you as an entrepreneur have to think about, how do I show people, convey to them that we're on this trajectory? How do I appeal to them viscerally to communicate that versus being on this trajectory? For me as a venture capitalist, not only do I have to worry about doing your Series A, but I'm going to be scratching my head saying, when they go out for Series B, they're going to be facing this, this desert of Series B funding because people are going to be waiting for the Series C. So I better have a pretty good syndicate partner, and I'm going to be really paranoid in your execution to make sure that after your Series A, that people get the idea that you're on this trajectory. Yeah.
What about the logic that you should actually fund them all the way through to C, right? Do fewer investments, but actually own them longer?
Yeah. So once we invest, we'll have a slide coming up on this. We'll continue to back you for quite a bit of time. I think what you're suggesting, Iklak, there's some merit in that. The problem is the way that people view success or failure is, do you get outside leads in each of your rounds of funding? So that's how you're getting validation that the business is good. So if I went to my partners and said, yeah, this company is raising Series B, they're doing great, but we can't find an outside lead, they'd say, well, it can't be doing that great in that case, because otherwise people would be beating down the doors. So you always want to be getting that outside lead at every round, because that shows that you have merit and value. So here's another thing that I suffer from, and this goes back to, once we invest, we're kind of invested in you for a while, which is the death by 1,000 cuts. So I invest in a company, and at the outset it looks great. They look smart and beautiful. They look great. We love them. Series A, there you go. A couple of years goes by, and you're raising the next round, and the company looks like this. But my problem is I remember the company when it looked like this. So I keep backing it, although somebody on face value would say, why are you investing in these dudes? And this is a question that we often ask ourselves when we're looking at a company at Series B or Series C, is would we invest in this company if it were coming in brand new? And the thing that we fall victim to is, again, we remember the company as it were, as it was, and we have this emotional attachment to the founders, the business, et cetera, and we will, not very well advisedly, but to the benefit of the entrepreneurs, we'll continue to back them. And we can get into a lot of trouble like that because you can start pouring money into a company that's not doing so well. And there is a parallel to that, which is you think about the guy at the slot machine, right? He's put in $50, he's lost it all. So he's thinking, well, I can't walk away now because I've already got $50 in it. If I just put in $10 more, I bet you I get all 60 back. So he puts in his $10 more. Does he get his all 60 back? No, he doesn't. So he says, well, now I'm $60 in. I'd look like a real fool if I were to walk away now. Why don't I just put in another 10? You know what? I'll take it up to 75. If I don't get all my money back by 75, I'm going to walk away. Still, 10 minutes goes by, he's $75 in, he still hasn't gotten his money back. Same thing happens in venture, okay? So because you think that, well, we've already put $10 million into this company. We're going to look like idiots to the LPs if we pull the plug now. It would be much better if we just put in just another $3 million from us, another $3 million from our co-investors, and the company's going to turn its business around. Will it happen? Who knows? Chances are, if it's not doing well, it may not do well. And so what you end up with is, the Walking Dead, right? This is the peril of just one more round, and we're going to turn it around. So you start off with the Series A, you do the B, you do the Series C, you bite hard, you do the Series D, and pretty soon you're into the Series E5, something like that, literally, right? So this is part of the reality that I live with, and the deal discipline of when should I pull out. But again, when you're talking to a venture investor, these are all the complications that are sitting in the back of my mind when I'm thinking, should I invest in this company or not? I'm thinking, will they be able to show traction quickly enough so that they don't end up in a company where I'm plowing in money round after round after round with no exit? So how do you counter that? When you go and you talk to your venture investors, say, here's the things I'm going to get done with the Series A. I'm raising my Series B. Here are the things I'm going to get done, so that your venture investor can see, oh, yeah, it makes sense. If he does those three things or she does those three things, the company's valuation will go up. It'll get some validation. It'll get an outside-led round of financing. Pretty highly technical stuff, right? Yeah, good. So here's a scene from my life. So this is an act. Every Monday, venture capitalists have their partner meetings, and actually took the camera in this past Monday and took some photos of our partner meeting in action. That's my partner, Terry. That's John, and there's Rob. And then this is what happens in a typical partner meeting. A little bit of that, and a little bit of that, and a little bit of that. So every Monday we go in. What do we talk about when we go into the partner meetings? We talk about how our companies are doing. So like this week, I had a board meeting yesterday. Monday morning, I'll go into my partner meeting. I'll talk about how my company is doing based on the board meeting. If the company's not doing well, I end up down here, right? If I end up down there too many times, again, I'm out of a job, right? So do I want to be down there? I don't want to be down there because, partner meetings, my partners are motivated by the same things that I am, that LPs are, which is to make money. If we're not making money, if my partners look at me and say, hey, all of his companies are going south, I'm down there getting pummeled every partner meeting, I'm going to be out of a job. Okay? So partner meetings are they're very civil because we're all partners. They're very civil, but they're pretty bare knuckle and hard-elbowed. And that's what goes on in a partner meeting. It's just talking about, well, how are your companies doing? What's going right? What's going wrong? What do we need to do? And if there are too many things in my portfolio that go wrong, I'm gone. So getting introduced to a VC. So you've got a startup. You want to meet up with somebody like me. And there's a question over here, which is how many deals do you see and how many do we fund? Here's the wrong way to get introduced to a VC. Oh, first of all, what does Goldilocks have to do with venture capital? So it's pretty easy if you think about. Then this is related to getting introduced to a VC. It's getting introduced to the right VC. If you remember Goldilocks, it was this one's too little, this one's too small, too big, this one's just right, this one's too hot, this one's too cold, this one's just right, et cetera. Same thing with venture capital. Depending on your funding needs, you want to go to a smaller investor, a medium investor, or a big investor. Okay, if you're doing clean tech, biotech, pharmaceuticals, medical devices, you want to go to a venture capital fund who can fund you for your big company that's going to chew up a lot of money. If you're doing an iPhone application, you can go to a small fund with $50 million under management. If you're doing something big, clean tech, and you have a lot of interest from a company that's a $50 million fund, it doesn't matter if they write your term sheet, don't take their money, because they will not be able to write you that next check to help your company succeed. Okay, same thing. If you've got if you're doing an iPhone application, you only need $500,000, $1 million to get your company to profitability. Do you want to go to a $2 billion fund? No, because how do you invest $2 billion? You don't invest at $500,000 at a time. You invest at $40 or $50 million at a time. You don't need $50 million. If somebody tries to force feed you, $20 million, $10 million, whatever, you get diluted. Is dilution good for an entrepreneur? No, right? So you only want to take as much money as you need, no more. So if you've got a business that has lower cash needs, go to a smaller venture fund. Don't go to a big one. If you've got a venture fund, a company that has high cash needs, go to a larger venture fund. Don't go to a smaller one. So don't waste your time going to the wrong VCs. So here's how you get, here's a picture of your typical VC. So there's a question here of how many deals we see in a year. We get about 10 deals over the transom, which means people email us those deals every day of the week. Every day of the week, all year long. Because people say, hey, I've got this company and some enterprise software, and I looked on the ONSET website, they do enterprise software, early stage deals. I'm going to email them my deal. But that's like emailing your photo to Steven Spielberg saying, put me in your next movie. It's not going to happen. It's the same deal, because if you email us your deal and we don't know who you are, you could be an axe murderer for all we know. So we're not going to invest. We have that space in our website where you can email your deals, specifically so you don't email it to me directly. Okay? Because I don't want to be seeing these 10 deals per day. So you'll send it in and you'll get a nice polite reply saying, thank you for your interest, we'll get back to you. But that's it. So if you want to get so that's called over the transom. Nobody funds over the transom deals, just like me sending my picture in to Steven Spielberg, good looking as I may be, would not get me in the next blockbuster movie. Okay, so the best way to do it is have somebody introduce you. So if you want to be in Steven Spielberg's next movie and your high school roommate's barber cuts Steven Spielberg's hair, whatever, have that person introduce you. Same deal with venture capital. If you want to get introduced to me, find out who knows me that you know, who can say, yeah, I know Iklok. He's actually a quality entrepreneur, and he's got this interesting deal which is a good fit for you. Then I'll look at it. I look at 100% of those deals. Not only do I look at 100%, I actually call them in for meetings. It's not just I read the business, I call them in for meetings because they came from a credible source. If Iklok can vouch for somebody, great. That works for me. Every deal I've ever done as a venture capitalist has been directly sent to me by somebody that I know, period. I've done exactly 0 that came in over the transom. So have somebody introduce you and get the right introduction. So the right introduction is, so here's a test. So here's 3 job titles, principal, vice president, and associate. Which of those is the highest ranking in the venture capital business? Principal, associate, and vice president. Principal? Trick question. The answer is they're all equal. Because in a venture capital fund, there's a hierarchy. There's the partners, the general partners, managing directors, and there's everyone else. The people who drive decisions for investment, the ones who sit on boards, et cetera, are the general partners, managing directors, partners. So the fact that you're connected with somebody who's a principal or a vice president really doesn't mean anything. So it means a little bit, doesn't mean a lot. So if you go in and talk to a venture fund and you say, hey, I sat down with Iklok. He's a vice president at Andreessen Horowitz. This is great. He loved our deal. You're not there. You have to say, Iklok, this is wonderful. You should like our deal. But who's the partner who would actually sponsor this deal? Who's the partner who would sit on my board? Because I need to talk to him or her. Can you introduce him or her to me at the next meeting? Okay? So don't get carried away by, I got a call. I get this actually from experienced CEOs in my portfolio where they say, hey, I got a call from a guy at Greylock, and he's a vice president over there. It doesn't matter. Okay? So the title has to be general partner or managing director. At our fund, you're either we don't use the term general partner. We use partner and managing director. But make sure that they have that on their job title. Venture partner doesn't count. That means they have a carry, but they don't really work there. So it has to be partner, general partner, managing director. Easy way to look at, of course, you can look at people's LinkedIn profiles. You can also look and see, hey, who's sitting on boards? Those are the people who you want. Okay? So get the right introduction into the venture fund. And if your friend offers to introduce you to someone who's a principal somewhere, that's not enough. So what you absolutely need to communicate to me to get funding are the following, that it's a big market, why your business model is disruptive. Note, I'm not talking about the technology, but about the business model. And why you or your team is uniquely qualified to be successful. So why are you guys going to be able to execute on this business plan and business model to address a big market? Notice I still didn't talk about the technology. Technology, unfortunately, just to say here in this, this temple of technology at Berkeley, technology is a commodity. It's the business model that wins. So these are the things that you need to communicate, period, end of story. Start with, know your customer, the business model. Don't tell us about the technology. You want to hear about the business model. All too often we hear about the technology and we say, who cares? How are you going to make money? We don't care about the technology per se. We care about the business model. Searching for a business model, there's 3 methods. Yeah.
To be fair,
Yeah.
on that last one, what happens is you care about the business model, and then you have this follow-up question.
Yes.
Which is,
Is the technology defensible?
Is it defensible?
Right.
Is it sustainable?
Yes.
How is it that somebody is not going to copy this in
Right.
a day and a half? And then all of a sudden, it's going to be like,
Yeah.
how credible are you, and how much time did it take to develop it?
Right.
And you get
Yep. Yeah. Yeah, I'm being a little bit harsh in saying that, stating that, just because we see too many people that come in and tell us nothing but their technology. We see slide after slide of diagrams of technology.
So you're saying get it in the right order.
Get it in the right order, because we do care about the technology, because you may have a great business model and a huge market, but if the technology is not defensible, then everybody and their brother is going to come in and do the same thing. So searching for a business model, there are 3 methods. First one, of course, is to talk directly to customers. How else would you find out, what your customers are going to be willing to pay for, what problems they have that they're going to pay for? So that's number 1. The number 2 best thing to do is to talk directly to customers. And then number 3 is talk directly to customers. Okay, some people debate the ordering of these, but I think this is the right order. Okay? So anyway, and there is no 4th best method. You have to talk to customers. When you come in and talk to us, that's what we're going to ask you. So how'd you come up with this idea? Why do you think it's going to sell? We want you to say, I talked to 100 customers, and 47 of them said that this is their big problem. And here's how we're solving it. That's what we want to hear. If you say, well, it's a great idea, or I read a report in McKinsey, you're going to be shown the door, because that's not what we're looking for. So talking to customers, 100% startups fail from lack of customers, not from a lack of technology. It's a truism, but it's. So talk to customers. Don't do this too much. We actually advocate just jumping in the trench and finding out. There's a little bit of merit to do this, but you got to go out there and talk to the customers, figure out what works, what doesn't work, because you want to rapidly figure out whether if your baby's ugly. Because if it is, you don't want to do it. And thanks to ICLOC for giving us this baby picture. Anyway, moving right along. Like I said, it's a very highly technical discussion, but hopefully you're getting the gestalt of all this stuff. Validating the market, Willie Sutton, bank robber, you have to use the Willie Sutton method. That said, Willie Sutton was a bank robber back in the Depression, and when they caught him, and this is not a true story. Everyone thinks it's just a true story, but it never happened. They said, why do you rob banks? He said, oh, that's because that's where the money is. Okay, everybody thinks he says that. He didn't say it, but I'm using his picture here anyway. So be like Willie Sutton and go after big markets, because remember that whole 9X thing that we talked about? We care about big markets. I literally had, within the past 6 months, an entrepreneur with a PhD in economics from the University of Maryland come in and tell me that she was chasing a $2.4 million market. Okay, that was the business that she was going after. That's not going to fly. So we like big markets because that's what's going to get us to that 9X. So yeah, and we've got this nice stock index, the Russell 3000, which is every company in America with more than $1 billion in revenue. Easy to go to if you're looking for big customers.
Good question about
Yeah,
markets.
yeah.
How big is big?
I have a slide coming up, and then just a sec. Yeah, and entrepreneurs think that I already know this stuff. Yeah, and I have experience that you don't know this stuff. Historical example is here's Columbus's Series A funding pitch or seed funding pitch, and he was going to go there. And of course, we know that a Series A pitch was something completely different, right? And this is a historical example, but it's happened to me multiple times as a startup entrepreneur. So, 1994, Broadvision, billing systems for interactive television, it was going to be huge. This is how the company raised Series A funding. And as we know, because we're all huge users of interactive television billing systems, this market didn't happen. We figured that out by talking to customers. We went out and talked to customers, and they said, we're not spending any money on this stuff. So we ended up doing something. We actually repurposed the technology to do on-the-fly personalization. On that, we took the company public. We went from 0 to $450 million in revenue in about 5 years and a $25 billion market cap. Okay, so despite the fact that we thought we knew it all, in fact, the founder of Broadvision, Pihong Chen, he's got a conference room named after him in Soda Hall, PhD from Berkeley in computer science, really smart guy. Despite that, and despite the fact that we even raised Series A funding based on this, we ended up doing something completely different. So as much as you might think, hey, I know this, you actually don't. Okay? So always talk to customers because that's what's going to continue to inform you on what you should know. So VC partner pitch, customer case studies work best. So if you were going to come in and talk to me, and you had just one slide to show. If you just showed, hey, here's what the customer is experiencing today, and here's how we're going to fix that problem. I just have that one slide. That works great. How do you figure out what that customer case study is? It's by talking to customers. Okay, so that's the number one thing. And I'll send out a soft copy of these slides, so you can read this at your leisure a little bit later. And remember, the business model always wins. It's not the technology, it's the business model. So the first slide's in your slide pitch. It has to be, it's a big market, and here's my business model for getting to that big market. That's what we want to hear. Later, you can tell us about your defensible technology. So some quick examples of disruptive business models, because that's what we care about. These are real-life examples. Incumbent Blockbuster got killed by Netflix because of technology or because of business model? Business model, thank you, exactly. Siebel Systems, if anybody remembers, was a gargantuan $25 billion market cap company about 10, 15 years ago. Got killed by Salesforce.com. Not because of technology, it was because Salesforce.com had a SaaS $65 a month per seat business model, and they killed Siebel Systems. Okay? Not because of technology. Siebel actually had more technology. Borders, put out of business by Amazon.com. Amazon, to their credit, are actually looking to attack their own business model to make sure that somebody doesn't put them out of business. So they're actually using ebooks to attack their physical book business. And of course, you look at Apple, which had a nice franchise with the Mac and has attacked that with tablets and iPhones. But in the end, it's always the business model that wins. So we care about big new markets, and there was a question here of how big is big. So we need multi-billion-dollar markets that we look for. So if you come in and say I'm addressing an $800 million market, a $900 million market, we don't care, because you're not going to get us a 9x multiple based on that. We want multi-billion-dollar markets. So if we're looking for multi-billion-dollar markets, but it's a brand new market, how do you figure out how big the market is? So I have the answer to that question exactly, and this is it. All right, any questions? That's pretty clear? Yeah? Okay, good. No, so the question here is, how many barbers are there in Chicago? That's your answer to market sizing, is how many barbers are there in Chicago? And you say, what does that mean? It means the following. So if I go to ICLOC and say, hey, ICLOC, how many barbers are there in Chicago? If he were dumb, he'd say, I'm going to go get a phone book and I'm going to count them.
Actually, no, it's 5,317.
5,317? All right. Okay, he did count them in the phone book. So I retract the thing about him being smart. No, but he's a smart guy. He's going to say, here's what ICLOC's going to do. He's going to say, how many barbers are there in Chicago? There are 2.7 million people in Chicago. Half are male, 85% of hair. So there are 1.15 million males needing haircuts. Barber works 40 hours a week, blah, blah, blah. You do the math, and you have a rough idea of how many barbers there are in Chicago. So you come in and talk to us, and it's a brand new market. We don't know how big the market is. You're going to say, we've done this proxy math to figure out that it's an $8 billion a year market. And if you tell us the assumptions that you made, we're going to say, yeah, that makes sense. Maybe it's $5 billion, maybe it's $8 billion, but it makes sense. We know it's not a $500 million market, not an $800 million market. So this is what you want to do, because in a brand new market, there is no industry report that says XYZ market is $5.7 billion a year, because no one else has figured out that it's a market yet. You have. So size the market by doing the barbers in Chicago analysis. Okay, it's a very powerful model. You can figure out anything using that. So 3 key steps to start your company. Again, find out if it's a multi-billion-dollar market. Do you have a disruptive business model? If yes, it's a multi-billion-dollar market. Do you have a disruptive business model? And the answer to that needs to be yes. And then you can talk about, do you have disruptive technology to keep people out? You need to have these answers chaining up to yes and yes. If you have a yes answer to this, you need to be able to tell me, who are you disrupting? Okay, so if you say, I have a disruptive business model, I'm going to say, yeah, really, who does that threaten? And you need to be able to say, well, I'm threatening IBM and Westinghouse or whatever it might be. Yeah.
So I've heard some other speakers say that that type of math is actually not very descriptive. I think one of the more famous examples is Guy Kawasaki, who's 1% of, or I guess the reasoning behind why they don't really care about a 1% argument. You say, like, my market's this big, and we're going to capture 1% of this market. We're going to make $100 million or whatever. How much do you guys actually rely on that type of math?
Yeah, we don't do this, the 1% example. We want to know that the market is defensively a big one, that you can say, yes, it is a huge market, that it's not a $500 million market, because what are your proxies for? So who's spending money in that now? How is that problem being met now? Oh, well, there's, Anderson Consulting does it, and they have $40 million a year in revenue from that. Okay, then it doesn't sound like a really big market. But if you could say, this is a huge problem today, and the problem manifests like this, and people are spending money here, there, and everywhere, and that's why we think there's demand there. We don't expect you to say, oh, imagine if we capture 1%, because we don't know what you're going to capture. In fact, if you're dominant, you're going to capture probably a third. You're going to capture 33%. But we do want you to say, this is a huge market. It's going unaddressed in the way that we mean to address it. That's what we care about.
And then does the market size also, what
No. It shouldn't be very much to develop your technology, because at that point, risk starts to ramify here. And one thing I put up here is, a market shouldn't be too big. Look at Tesla as an example. And not that I saw Tesla's funding pitch, but when they got the company funded, I'm sure they didn't go out and say, we're going after the automobile industry, which is $2 trillion a year, or whatever it is. They probably went out and said, we're going after the market for rechargeable, electric, high-end vehicles, period. And that happens to be a $4 billion a year market today, whatever. So make sure you're not looking at a market that's too big, segment it appropriately. And if the answers to all of these are yes, and here's the number one reason why a startup succeeds or fails is the quality of the team. So Eklok mentioned I worked at these companies, number of companies that went public, and the nice thing was that each of those companies, the entire time I was there, I was the least experienced, dumbest person in the company. And that's when I knew the company was going to succeed, because I'd look around my fellow employees, and everybody was way more experienced, way smarter than I was. And that's why I knew the company was going to succeed. So does everybody know who Diego Maradona is? Yeah, he's the Lionel Messi of 30 years ago. So this is Diego Maradona playing against Belgium in the World Cup in 1982. So bear in mind, there are 10 field players and a goalie and a soccer team. They've got 6 guys covering this guy, right? This is what you want to do when you're hiring. You want to hire, you want to hire somebody like this, because remember the picture of the little kitten in the beginning. In a startup, you don't have the option of overwhelming people with lots of staff. You're going to have the one guy or one girl going up against a competitor with way more resources. So you want people who are really, really capable. And the last thing you want to do ever is to compromise your hiring standards. Okay, so you always get people who are smarter than you are, period. That was always my instruction to people in my groups when we were recruiting, saying that if this person isn't more capable than you are, we're not hiring them. And that you can keep the quality of your team up. Because otherwise, the first time you compromise, say, well, this is not right, but he's 90% there. Well, guess what? The next one is 90% of that guy, and the next one is 90% of that guy. And pretty soon you're hiring Stanford students. Okay? Perish the thought that you should have to do that. So fundraising step function. So this is important because you come in and talk to us and say, I'm raising money. And we say, how much money are you raising and how and why? You need to have a credible answer to that. And the reason for that is that you never want to raise too much money, because what happens when you raise too much money? Dilution. Is dilution good for entrepreneurs? Thank you. And if you raise too little money, what happens? You go out of business. Okay? So here's how fundraising works. Is you raise some money, and it could be on a convertible note. There was a question on this a little bit earlier. We do convertible notes. Angels do convertible notes. If you raise some money, you use it to accomplish some things. Having accomplished those 3 things, whatever it might be, your valuation goes up. You raise your next round of funding when your valuation spikes. You raise that money. You achieve some more milestones. Those milestones are exactly the ones you need to spike your valuation once again, and you raise your Series B. So you're raising money on the inflection points when your valuation goes up. So the amount of money you raise is exactly enough to get you from here to here, from here to here, et cetera. So you come in and talk to me, you're raising this round or this round, whatever. You're going to say, I'm raising this, and here are the 3 things I'm going to do with that money. And I'm going to say, yeah, if he does those 3 things, valuation will go up, and I can raise a Series A at a higher valuation. Or if he does those 3 things in the Series A, valuation goes up, and we'll raise the Series B at a high number. Again, what you don't want to do is to raise too much money, because too much is dilution. Too little puts you out of business. Okay? So you should have an understanding of how much money you need, and that's driven by what are the validations which are going to spike my valuation. So whether you're at this stage or this stage or that stage, think about, what do I need to do to increase my valuation? Is it customers, partners, product, whatever? Those are the things you want. Now, I saw a funding pitch last week which said use of funds. Here's what it was, and this is from an experienced CEO. Use of funds was marketing, engineering, sales. He may as well have said salary and rent. Because if you're spending money on marketing, engineering, and sales, well, yeah, no shit. But, but what is it that you're going to do with that money which will increase your company's value? So what you should have been saying is sign up these 2 OEMs, take the company to $5 million revenue, whatever. Things which tangibly will increase the value of the company. Okay? That's the kind of stuff I want to see. So remember this, and when you come in, have in mind how you're going to spend your money. And so, after you know your customer, building and I think all of this is implicit in what we've talked about. Funding pitch should be no more than 15 slides PowerPoint. Earlier this year, I got a funding pitch that was 45, 47 slides. I didn't look at it because I figured if you can't tell your story in 15 slides, you actually don't understand your business. Okay? So no more than 15 slides. Again, I'll send out a soft copy of this so you don't have to take all this down. But this is the kind of stuff you want to communicate in those 15 slides. And remember, as risk goes down, your valuation goes up. So the more that you can show me that you've taken risk out of the equation by recruiting customers, building the product, building a prototype, whatever, as much as you can come in with, that shows me that the risk has gone down. To your benefit, your valuation goes up. Because if your valuation goes up, your dilution goes down. Okay? So at all times, you want to communicate that you've reduced the risk. So clearly illustrate that. VC phrase book. We always want to know is, do you want to be rich or do you want to be king? If you're rich, then we're rich. If you're king, there's no implication that we've made any money. So we'll ask you a question of how do you see your role in your company in the next couple of years? And what that means is, okay, you may be the CEO today, but as the company grows, maybe you're not the CEO. Maybe you're the VP of strategy, the VP of marketing, whatever, and a new CEO needs to be brought in for the good of the company. So your right answer is, I want to do whatever it takes to make the company successful because I realize it's all about the stock. It's not about your business card that says CEO. It's about the value of your bank account. Okay, so we want you to be rich because if you're rich, by implication, we made money on the deal. Okay, this stuff is pretty clear, but you've got to be careful about what people say. Read into that. Anything where people are getting involved directly, like the partner themselves, that's a good sign. Deal terms, don't get hung up on valuations. You always want to pick the best investor, not the one that gives you the best valuation. Just like you want to pick the best spouse, not the one with the fanciest car. Same thing with venture investors. Get the best investor, not the one with the highest valuation. In fact, lower quality investors will overpay on valuation just to get into the deal. How much money should you raise? We talked about that. Warning, not all term sheets are friendly. Get a really good attorney. A really good attorney means one who works in Silicon Valley for one of the big firms and does 100 deals a year. It does not mean your cousin or your brother or whoever, because unless your cousin or brother is doing 100 deals a year in Silicon Valley startups, they actually don't know the nuances. So make sure you have a savvy attorney. Follow up after you give a pitch after Monday, because partner meetings happen on Mondays. So if you give a pitch, follow up after the following Monday. If they tell you no, find out why so that you can hone your pitch. You don't want to become the 40-year-old virgin. What this means is you don't want to become a shop-worn deal. If you're still raising money 6 months from now, you're never going to get money from me, because if I saw you and then I see you 6 months later, there's no momentum in your deal. So all startups have shelf life. Don't exceed it. As we've been talking about, don't get intimidated by the VC, because as with the Wizard of Oz, we're just human back there ourselves. And last slide here, who wins this battle? David. Who wins the battle in Silicon Valley? 100% of the time, the startup. Did Facebook, LinkedIn, Google, any of these come out of IBM or HP? Zero. So the startups always win. So if you've got a vision, you want to be an entrepreneur, go do it. It is the best job in the world. If you do it right, you're going to win. Okay, that was it. Yeah, so there's a question on convertible notes. So convertible notes are great. If you're doing anything before Series A, whether you're going to an angel or coming to a venture investor, ask for the convertible note. Because at that early stage, who knows how to value your company? What a convertible note is, and we do these all the time, angels do them all the time, is we'll say, oh, you need $100,000, $200,000, we'll give you $200,000 as a convertible note. It converts at your Series A. It'll convert at a discount. So for my reward for having risked the money in the convertible note is my $200,000 will convert at a discount, usually up to 25%. So I can buy shares that are $1 a share at 75 cents a share at your Series A. The nice thing about a convertible note is if your company works out, great. I benefit because I get to buy the shares a little bit cheaper, and you get my money. And if the deal doesn't work out, I don't take the money back from you. Right? It's not a loan. It's a convertible note. So you say, hey, Shomit, sorry, the deal didn't work out. Oh, well, I lost, you lost, great. And we'll take that. That's the risk that we run, and we're happy to take that risk. Convertible notes are a great way to go because it's unsecured. It's not like you have to put your house up or your car up as security. Okay? So if you can get it, go do that. And for really early stage money like that, convertible note is the way to go. Yeah?
So you're mostly because of pressures on the
We know that there are companies like WhatsApp that go out really quickly. We've never had the benefit of having a deal like that because we invest in deals that are typically like enterprise software, things like that, or medical devices, which we know have a long baking time. So for a software company, if the software company can get liquid in 5 to 7 years, we're very happy. If it's not liquid in 5 to 7 years, probably things aren't going as well as we'd like it to. That said, we had an exit a couple of years ago in a company we'd been in for 12 years. And we believed in it. We believed in the entrepreneur. It was the same CEO the whole way through. And because we stuck it out, we made a really nice return on that company. So sometimes that happens. But generally, after that 5 to 7 year period, you know what trajectory the company's on.
Does the startup world have a disruptive technology? What if it's the business model itself?
It should be the business model. The reason why you want to have it, the technology needs to be something that it's not easy for other people to replicate. Otherwise, they'll say, "Oh, that's what he's doing. Yeah, I'm going to do the same thing." So, and especially from a bigger a legacy player already in the space, that's probably exactly what I'm going to do. So you'd like to have something that's defensible because of the arcane knowledge that went into it or the technology or whatever, but you want the technology to be defensible.